Welcome back to the deep dive. So today is, well, it's a bit of a weird one.
Oh, hope so.
Usually when I'm prepping, I'm wading through, a sea of PDFs, Bloomberg articles, maybe a white paper or two.
It's the usual stuff.
Usual stuff. But today, I'm holding just one document. And I have to be honest, when I first looked at it, I almost just tossed it.
Why is that?
Because right there at the bottom, in parentheses, it literally says secret info.
Ah!
And, when I see secret info stamped on a PDF these days, my clickbait alarm just starts ringing off the hook.
Yeah.
It feels a little dramatic.
It does. It screams conspiracy theory or, some kind of marketing gimmick, but you didn't throw it away.
I didn't. And that's because of the timestamps. We're recording this on February 11th, 2026.
Right.
This document flags a specific market event that it claims kicked off on February 5th.
Just 6 days ago.
Just 6 days ago.
Right.
And when I cross-reference the claims with what's actually happening on the charts right now, well, clickbait started looking a lot more like a leaked playbook.
That's the thing about secret information in finance, isn't it? Sometimes it's nonsense, but sometimes it's just information that hasn't been priced in by the public yet.
Exactly.
And if this document is even close to accurate, we aren't just looking at a market trend. We're looking at a coordinated takedown of a specific currency pair.
And we are talking about the Swiss franc versus the Japanese yen, the CHFJPY pair.
A classic pair.
And this document, it is not subtle. He says this pair is set for the biggest fall very soon.
Biggest fall! Wow. That's aggressive language. Usually analysts hedge, right? They'll say potential downside or a bearish outlook.
Right.
To explicitly call for the biggest fall implies a very high confidence, high velocity event.
So before we get into the who, and believe me, the list of names in here is just mind-boggling, we need to talk about the what.
Okay.
Because the comparison this source makes is, well, it's strange.
You're talking about the asset comparison.
Yeah. The source says, and I'm quoting, the market down looks like gold, silver, and BTC. And that just stopped me. Bitcoin, gold. These are commodities in crypto. CHFJPY is a fiat currency pair.
Totally different asset classes.
Yeah. Usually when a currency's falling, you compare it to the euro or the pound. Why on earth would you compare a Forex pair to Bitcoin?
I think this is where we have to read between the lines a bit.
Mm-hmm.
They aren't talking about the asset itself.
Okay.
They're not saying the yen is suddenly a crypto. They're talking about the market structure of the move.
So speed, volatility.
Exactly. Think about how fiat currencies usually move. They drift, they grind.
Yeah.
A 1% move in a day is a huge deal in Forex.
A huge deal.
But Bitcoin or gold in a crisis, they don't drift. They move vertically, they go parabolic, or in this case, they crash vertically.
So by saying BTC, they're telling us to expect a kind of volatility that just breaks the normal rules of Forex.
Precisely. They're signaling this isn't a correction, it's a liquidation event. When you see a chart that looks like Bitcoin during a crash, it means everyone is rushing for the exit at the exact same time.
Which suggests panic.
Oh! Or, and this is way more likely given the rest of the document, a forced liquidation.
Okay, so a vertical crash, but let's play devil's advocate for a second. Markets don't just crash because a PDF says so.
There has to be a catalyst.
A mechanism. And this is where I got a little skeptical again. The source points to a specific policy change from the Japanese central bank.
The interest rate hike.
Right. It says the Japanese central bank is hiking rates from 1% to 1.5% this year in 2026.
Which is a significant shift for Japan.
Is it, though? I mean, look at the rest of the world. The U.S. Fed, the ECB. They've been dealing with rates much higher than that. We're talking about a move of 0.5%.
50 basis points.
50 basis points. In the grand scheme of the global economy, is a 0.5% hike really enough to cause the biggest fall in history for this pair? It feels like a drop in the bucket.
If you look at it in a vacuum, sure. If you're just, a guy with a savings account, 0.5% doesn't change your life.
Right.
But in the institutional world, that 0.5%, it's everything. You have to understand the context of the carry trade.
Okay, let's unpack that, because I hear carry trade thrown around a lot, but why does it make a 0.5% hike so dangerous right now?
So for decades, Japan had zero or even negative interest rates. It was essentially free to borrow Japanese yen.
Okay.
So what did every big bank and hedge fund do? They borrowed billions of yen for free, converted it into other currencies like the Swiss franc or the US dollar, and then bought assets that actually paid a yield.
Free money. You borrow at 0%, you invest at 4 or 5%, and you just pocket the difference.
Exactly. That is the carry trade. It's been the engine of global liquidity for a long, long time. But here's the catch.
There's always a catch.
It only works if the yen stays cheap and those interest rates stay at zero. The moment the Japanese central bank starts raising rates, even just to 1.5%, the cost of that borrowing goes up.
And the profit margin shrinks.
It gets worse. It can turn negative. And because these institutions are so leveraged, I mean, borrowing 10, 20, sometimes 100 times their actual capital, a tiny move in rates forces them to unwind the entire position.
Ah.
They have to sell the asset, in this case the Swiss franc, to buy back all that yen to pay off the loan.
And if everyone tries to do that at the same time?
You get a squeeze, a massive squeeze. And that's why the source compares it to Bitcoin. It's not about the fundamental value of the Swiss franc. It's about a crowded theater where someone just yelled, "Fire!" and the only exit door is the Japanese yen.
So this 1.5% hike, it isn't just a policy tweak. It's the match that lights the fuse on decades of leveraged betting.
Correct. And the document even gives us the target of that explosion. It says the central bank has decided on a CHFJPY price of 160.00.
160. That's the magic number.
Which is incredibly specific. Central banks usually guide directionally, you know. They don't typically leak exact price targets unless they are actively trying to anchor the market.
So they're sending a message.
They are. If they want 160.00 and they're hiking rates to get there, they are effectively telling the market, we are taking this pair down to this level, get out of the way or you will get run over.
And just to remind everyone, this is framed as happening now. The document says the shift started after February 5th. We're sitting here on the 11th.
You should already be seeing the cracks forming.
And we are. That's the chilling part. The volatility picked up on the charts right on that timeline.
It did.
But this is where the secret info label actually starts to make me sweat a little. It's not the rates. It's not even the target price.
The list of who's in on it.
It's the participants list.
Yeah.
When I read financial institutions are buying JPY, I assume, okay, maybe Nomura, maybe some big Japanese insurers.
Yeah.
But that's not what this says.
Yeah.
It lists countries. And I want to go through this list because it feels, well, it feels contradictory.
Go for it.
Okay. So first you have the usual suspects. The USA, the United Kingdom, Germany, France.
The G7 Western Alliance. The financial heavyweights, that all makes sense. If Wall Street and London are unwinding trades, they're big enough to move the market on their own.
Right. But then, in the very same list, the source adds China, Russia.
Okay, hold on.
Saudi Arabia, the UAE.
And that is where you should pause.
Exactly. Russia and the U.S. On the same side of a trade, China and the U.S., who are in this, fractured economic Cold War, are both agreeing to sell the Swiss franc and buy the yen at the exact same time.
It's extremely rare. I mean, geopolitically, these nations are rivals. They're actively trying to undermine each other's currencies. But the market is different.
How so?
Because profit is the ultimate neutralizer. If the Japanese carry trade is unwinding, it doesn't matter if you're a state-owned bank in Beijing or a hedge fund in New York. The math is the same for both of you. If you don't sell, you lose money.
So this isn't a political alliance. It's just a synchronized exit.
It's a stampede. But just think about the sheer scale of capital we're talking about here. You've got the petrodollars from Saudi and the UAE. You have the massive manufacturing surplus of China and Germany.
The financial leverage of the U.S. and U.K.
And it even lists Brazil and India, the emerging giants.
It's basically the entire G20 minus, well, Switzerland, I guess.
Tuckles. Yes, poor Switzerland. They are on the receiving end of all this. But seeing that alignment, East and West, BRICS, and G7, it suggests this isn't just a trade. It's a global repricing of risk.
What do you mean?
It suggests that the entire world financial system has come to a consensus that the yen is the place to be right now, and the franc is the funding source to burn.
And the document gets even more specific than just countries. It actually names names.
It points fingers at specific institutions.
Citibank and JP Morgan Bank.
Two of the biggest behemoths in American banking.
Yeah, and the source says they have already hugely sell CHFJPY. I mean, the grammar's a little off, but the message is crystal clear.
It's very clear. These institutions are market makers. They don't just react to the price, they set the price. If Citi and JP Morgan have already offloaded huge amounts of this pair, they did it before the retail public even knew what was happening.
And that lines up perfectly with that February 5th date.
Yeah.
They move first?
They always move first. That's their job. But think about the implication of them moving in lockstep with the Japanese central bank's own target.
It feels like inside baseball.
It suggests a high level of, let's say, communication. Central bankers signal their intentions to the primary dealers banks like JP Morgan. We're going to 1.5. We want the pair at 160. The banks take that info, they position themselves, and then the policy becomes public.
So this document is like a snapshot of that moment in between.
Exactly. The big players have moved, but the full impact hasn't hit the public tape yet.
And you know, there's one more country on that list that I almost skipped over, but you pointed out it's actually really important. Belgium.
Yes, Belgium.
Why Belgium? I mean, great chocolate, but are they really a financial superpower?
In a plumbing of the financial system, absolutely. Belgium is home to Euroclear.
Euroclear. What's that?
It's one of the world's largest clearinghouses for securities. Trillions of dollars of bonds and equities pass through there. If Belgium is listed as a participant, it's not about their banks, it's about the custodial flows, the actual movement of sovereign bonds.
So it's about the pipes.
It's about the pipes. And it adds this layer of credibility, you know. A scammer might just list USA and China to sound big. A real insider lists Belgium because they know that's where the actual settlement happens.
That's a fascinating detail. It grounds the whole secret info thing in the boring mechanical reality of how money actually moves.
Exactly.
Okay, so let's zoom out. We have the Japanese central bank hiking rates to 1.5%,
We have a price target of 160.0.
a timeline that started just last week. And we have this coalition of the willing from, the U.S. to Russia, all betting against the Swiss franc.
It's a perfect storm.
But I want to go back to that comparison one last time. Looks like gold, silver, and BTC. If this crash really happens, if we see that vertical drop, what does that do to the average person? Most of us aren't day trading CHFJPY.
No.
So why should the guy driving to work right now care if the Swiss franc collapses against the yen?
That's the million-dollar question. Or maybe the trillion yen question.
Yeah, right.
You have to remember that the yen carry trade, all that borrowing of cheap yen, it funded everything.
Everything.
It funded the stock market rally. It funded real estate booms. It funded crypto speculation.
So if the funding dries up,
If the funding currency, the yen, skyrockets in value, liquidity gets pulled out of every other asset. The reason they compare the crash to Bitcoin and gold is that the volatility could easily spill over.
so a hedge fund selling the franc to buy yen might also be selling their stocks to buy yen.
Or their bonds, or their crypto.
Yes.
So this secret info isn't just a warning about a Forex pair, it's a potential warning about a liquidity shock across the board.
A tremor that precedes an earthquake.
That's a good way to put it. When you see a safe haven currency like the Swiss franc getting slaughtered, it means the market is undergoing a really violent rotation.
It's like watching the foundation of a house crack. You might not be in the basement, but eventually those cracks reach the living room.
That is a very apt analogy.
So we've got this document, we've analyzed the numbers. 160 target, 1.5% rate hike, February 2026 timeline. It all seems pretty solid, despite the flashy secret stamp.
The data points align with the macro reality. Japan has needed to normalize rates for years. The inflation pressure is there. The timing makes sense.
It's funny, we started this deep dive looking at a piece of paper that felt like a prop from a spy novel, secret info, big as fall.
Right.
But after peeling back the layers, it's really just a story about math.
It usually is. It's about interest rate differentials and leverage.
Right.
It just so happens that this particular math is forcing enemies to become temporary allies.
That's the nature of the beast, I guess.
Mm.
The market doesn't care about your flag. It cares about your yield. So as we wrap up, I want to leave our listener with one final thought, and it goes back to that list of countries.
It is striking.
We spend so much time reading headlines about fragmentation, right? The world is splitting apart, East versus West, dollar versus yuan.
All the time.
And yet, here's this document. And it claims that on February 5th, 2026, the banks of China, the banks of the U.S., the banks of Russia, and the banks of Saudi Arabia all looked at the same chart, saw the same opportunity, and pushed the exact same button, sell.
A singular moment of global consensus.
Exactly. So my question, and the question I want you to think about, is this. If the financial incentives are strong enough to line these massive geopolitical rivals on a single trade, what does that tell us about who really runs the world? Is it the politicians making speeches? Or is it the flow of capital that forces everyone eventually to swim in the same direction?
It certainly makes you wonder if the real secret info is the trade itself or just the realization of how interconnected we all really are.
A sobering thought. Thanks for helping us decode the signal from the noise today.
My pleasure.
And thank you for listening.